Hello, welcome to the Market Cover. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, for joining us. I just want to mention one more time that we do have the third lease coming up. Hopefully, you have those invites in your inbox. If you haven't had a chance to read them and click an RSVP, please do so. We'd love to have you if your schedule permits. If not, we'll hope to catch you on the digital side. So as we move to content this week, we've got a couple of points between Andrew and myself. We'll be talking about what we think the yield curve is saying, a different portion of the yield curve than we're normally talking. And then Andrew taking a look at the pullbacks and uptrends that we are seeing. So let's dive right into what the yield curve is saying. Typically, when we say yield curve, we're talking about the difference between the yield on a 2-year note and a 10-year note. But here we're just focusing more on the very front end of the curve. And we're looking at the difference between the 2-year note and what the federal funds rate is. So just for the picture here, so the federal funds, when they meet and they change interest rates up or down, what they're talking about is that federal funds rate. That's really the rate that they control. And then the rest of the market kind of adjusts to that. And typically, 2-year notes, because that's not too much time out from where a federal funds, which is an overnight rate. Since 2 years isn't that much, you'll usually find those two very closely together. But we have seen a gigantic spread emerge where there's almost, at one point in time, a 2% difference between the yield that you'll get for holding a 2-year note and for holding things that were really near term or almost overnight in yield. So this has made some implications for the portfolio. This has been good for us as we've been invested in things around that 2-year note time frame. So as those yields came down, we saw some price appreciation, and that's good. But the other thing that I would mention is that we've seen a couple periods of pullback, one in early August and a mild one here so far in September. And during both of those, we see a different action from bonds than what we saw during much of the prior several quarters, going back to 2021, 2022, where we saw stocks and bonds drop together. So that has been a very helpful piece for our diversified portfolios. Can't guarantee that would continue, but during these pieces, I think that's a very key difference in the market. So that's the fixed income side. I'll pass it over to Andrew for stocks.
Thank you, Adam. So if you saw last week's Market Carver, we talked about seasonally September can be a rough period. We can see a lot of chop at the start of the month, and ending historically can be some more turbulence. And last week was a great example of that, as we saw the market, the broad indices and equities start to pull back. And so we started getting some questions. Is this the start to something more protracted? Is this a buyable dip, as what's often called? And so wanted to discuss that this week with this specific chart, looking at different types of environments, different types of trends and setups we can look for depending on if the market is in an uptrend or downtrend. So we're simply going to define the market as being an uptrend if it's above its long-term average price. If it's above its long-term price, it's in an uptrend. If it's below it, then we're in a downtrend. Examples of that, back in 2022, we saw a protracted bear market, declined over 20%, and the market was in a well-defined downtrend. However, since then, we've actually been in an uptrend. The market's continued to make higher. We're making new highs. We're all encouraged by that. And so we have these two different types of market environments. And so we can then evaluate in looking at the shorter term time frames when we start to see the market pull back. If we're in those uptrends, that's where we get those green arrows on the chart that you're seeing on your screen right now. That's when we start seeing short-term declines. We get a little bit of a stretch in that proverbial rubber band. But since we're in an uptrend, those are often opportunities to look for buying those dips, those pullbacks that often see the market move higher from there forward. However, when we're in a downtrend, that's where we start getting those red arrows. Those type of buyable dips become less so, and we continue to see the market oftentimes continue to move lower like we did in 2022. Why this is important is right now, we're actually not even to a point where the rubber band is even that stretched. We're only 2% below our short-term averages, but we're still in a defined uptrend. And so we share this to say that there are different types of opportunities, but we need to identify the overall trend to know which ones are the ones we want to be looking out for. Right now, since we're still in an uptrend, we continue to look for opportunities from a good risk reward perspective for the portfolios and continuing to monitor every week what is the health of the trend, what's the price action doing, how do fundamentals are shaking out as we get earnings reports, and on and on. But we always want to keep the short-term price action in perspective of what the long-term trend is, recognizing that sometimes when we get those volatile weeks like last week, it can make that a little bit harder to focus on the data and not let our emotions take over. But that's what we do, and that's our job. And so we always want to keep that long-term trend in perspective.
Absolutely. Thank you, Andrew. And thank you to all of you who clicked and gave us your time. We sure do appreciate it. As always, if we can be of service to you, something triggered a question, or you just have something else we can be of service, please give us a call, 800-928-4001, or scan the QR code and book it electronically. Thanks again. Have a great weekend.